We begin the new week with markets still dominated by geopolitics as the conflict between the US and Iran continues to overshadow economic data and drive cross asset price action. The lack of any meaningful de escalation over the weekend has kept the geopolitical risk premium firmly embedded in energy markets, while investors continue to balance resilient US economic data against expectations for Federal Reserve policy. In FX, the US dollar enters Monday on a firmer footing after Friday's stronger than expected US data reinforced the view that the U.S. economy remains resilient despite moderating inflation. June housing starts surprised sharply to the upside, consumer sentiment improved more than expected, and import prices rebounded, offsetting softer industrial production. The dollar was broadly supported into the weekend, although commodity-linked currencies held up relatively well thanks to higher oil prices. The Canadian dollar was the strongest performer on Friday despite fresh tariff rhetoric from President Trump, while sterling underperformed amid broader risk aversion. The yen continues to find itself caught between safe haven demand and still wide US-Japan yield differentials, limiting sustained appreciation despite the elevated geopolitical backdrop. Equity markets ended last week under pressure, led by technology. The Nasdaq fell by more than 1% on Friday as investors reacted to concerns that Moonshot AI's new Kimi K3 open source model could accelerate competition within artificial intelligence and potentially reduce the economic moat around large language models, prompting another bout of weakness across semiconductor stocks. Although many chip names recovered from their intraday lows, Nvidia remained under pressure, while disappointing earnings from Netflix and a sharp decline in Intuitive Surgical added to the negative tone. The S&P 500 also finished lower, capping a weaker week for U.S. equities overall. In commodities, oil remains the clearest reflection of geopolitical developments. WTI crude climbed to one-month highs as military tensions continue to escalate and markets priced in the growing risk of prolonged supply disruptions through the Middle East. Weekend developments offered little encouragement from fresh U.S. military strikes, further Iranian retaliation, and renewed attacks across the Gulf, reinforcing concerns that the conflict could broaden further. Shipping disruptions through the Strait of Hormuz remain a key focus, keeping energy markets highly sensitive to headlines. Looking ahead, investors will continue to monitor developments from the Middle East above all else, with any signs of escalation or de-escalation likely to dictate early week risk sentiment. Alongside geopolitics, attention will gradually shift towards another busy week of corporate earnings, while central bank expectations remain sensitive to incoming inflation and labor market data after last week's mixed but generally resilient U.S. economic releases. For now, the macro narrative remains one of resilient U.S. growth, sticky geopolitical risk, elevated oil prices, and markets that remain highly headline-driven. That's all for now.